Good morning, everybody. Good afternoon, wherever you're at. I want to welcome everybody to our first episode of Leading Indicators. I'm Russ Allegrette, and I am the CEO of Ocean West Capital Partners, as you see in the back. We've got Dennis Kiely with us today, who will be joining me on various other podcasts. And then we also have Mike VK with us, who I'll get into a little bit more on his background in a second. The purpose of these podcasts are, Dennis and I have quite a variety of overseas clients. And in these tough, turbulent markets, we get a lot of questions. And I think that there's a lot of confusion about what's going on in the U.S., both from international investors as well as U.S. investors. So we thought the best way to attack this would be to get the real expert on with us and interview who we thought was best in class in commercial real estate. Today, we're going to be talking about distressed debt. One thing we're really fortunate to have is Mike VK on with us. I've known Mike for 25 years, dear friend. I think most or a lot of people consider Mike the preeminent expert in commercial real estate debt in the U.S. and abroad. I know his firm has done more commercial real estate debt than any other firm in the U.S. or in the world. Mike's the president of Eastdil Secured, probably one of the smartest people that I know. So Mike, welcome.
Thank you, Russ. That was very generous.
So let's just jump in. So Mike, why don't you just give us a little bit of background on, how you guys are helping clients at Eastdil Secured and, what you're doing.
The firm, we're fortunate to do circa 150 billion to 200 billion a year in capital market transactions. That would be sales, M&A transactions, loan sales, new financings, joint ventures, fundraising. And so the firm has seen a lot of different capital activity. Our roots go back to the early 90s when we were very involved in the distressed debt era of that period, which was the RTC. And then obviously we had a number of situations during the GFC. And so we've been fortunate over the last 15 years since the GFC to do about $100 billion of lender-related transactions, loan sales, short sales, UCC foreclosures. I was looking at the stats over since January 23, so roughly about 15 months ago, we've completed about $10 billion of lender-related transactions. That's been about half of that has been loan sales. So about $5 billion of loan sales, about $4 billion, so 40% of it has been in borrower and lender cooperative short sales. So where we've got the borrower agreeing with the lender to sell the property and give all the proceeds to the lender because the value is below the value of the debt. And then the other 10% has been running UCC foreclosure processes for mezz lenders who are looking to take control of the collateral because their loan is in default. So that's been our activity in terms of transactional activity the last 15 months or so. I think the other thing that we've seen a lot of is a lot of lenders are looking for BOVs, but broker opinion of values. What are assets really worth? And so that's been a big, very active part of the business too. I think I was looking at the stats this morning. We've done almost 47 billion of VOVs in the last 15 months. We're getting a lot of practice at that. Looking at those stats, about 80% of those BOVs for lenders have been related to office product, and about 70% of that has been in what would be the kind of people refer to as the big blue cities of the U.S. So San Francisco, Chicago, D.C., New York, L.A. in particular have been heavily where we've had those most of that lender inquiry about where are things worse. So that's what we're doing right now, trying to identify where there are challenges, how do we get solutions, how do we bring capital to bear, and what are things really worth in a still a pretty opaque market activity where transaction activity last year was the lowest we'd seen in almost since the GFC, almost 15 years. Wow. So we've got limited data points. They're growing, but that's what we've been focused on.
That's a lot of volume, and seems like that portends potentially a lot of trouble. Mike, why don't you let's just start big picture. So let's talk about the economy. The economy seems like it's strong in the US. I mean, we keep getting job growth and, the problem is inflation, at least recently, but our commercial real estate markets seem like they've been hurt. Obviously, office hurt more, but just across the board. Why is that?
Yeah.
What are you seeing?
Well, I think what we're seeing is, the economy in the US has been amazingly resilient, right? I don't think any of us would have thought you could take rates from 0 to 5.25, 5.5 in 16 months and not have something major break. So we've had this very resilient economy. And I think part of that is rate increases have not affected the general economy nearly as much as I think it's affected us in commercial real estate. And I think what you saw was most corporate borrowers, companies had already borrowed long-term fixed rate debt. So rising rates did not really impact their cost of financing. Most consumers who, if they owned a home, they had refinanced their home multiple times and are now have a long-term fixed rate loan on that. So rising rates didn't really affect their payments. But in the real estate space, where we've always been particularly in the last 15 years, very focused on flexibility, very few real estate owners really termed out long-term fixed rate debt. I was looking at the stats. We were fortunate to arrange about $85 billion of debt in 21 and probably $65 billion of debt in 2022 for borrowers around the world. 80 to 85% of those financings we arranged were all floating rate, and
Wow.
80% of those 80% of that floating rate debt was hedged only with 2-year caps. So you've got a situation where in the real estate space, we've been very impacted by interest rates in terms of how we value and finance the product. So I think that's been the big difference. The corporate borrowers and the corporations of America haven't been affected by interest rates that much. The consumers, which represent 70% of the economy, haven't been impacted that much by real estate because they've got long-term fixed rate home loans. It's really been, we've been kind of the eye of the storm of being impacted by interest rates.
Continue with interest rates. What are your thoughts about the long and short-term rates over the next 12 months? I know Jamie Dimon, was talking about 8% interest rates, right? Long term, but interested to see what your thoughts are on in the short term, the next 12 to 24, and then what your thoughts are in terms of where you think long-term rates might be heading.
Well, I think I think longer term, I think we've heard loud and clear from the Fed. They are absolutely committed to this 2% inflation target. And so long term, I believe if you have 2% inflation and we aren't manipulating the markets through quantitative tightening or quantitative easing, which I think we're kind of done with that modern monetary theory policy. So we're back to a market-based rate. If we have 2% inflation, that means short rates, i.e. SOFR, should settle in at some point at 2.5 to 3. And long rates should settle in someplace at 4, because if you have 2%, 2 to 2.25% inflation, you need a real return of 75 basis points or so over that, another premium for locking your money up for 10 years of another 75 basis points, 100 basis points. So we really should, I think we long-term should anchor our underwriting around assuming 3% short rates and 4 to 4.5% long rates. So I think that's where we go long term. The question is, how fast do we get there? And can we get there without a major recession? And I think that's the challenge for the Fed right now is they haven't been able to cool things as much as they wanted. Part of that is because we're running in the US $2 trillion deficits. It's part of why our fundamentals are so good, is that we've got a lot of deficit spending. So we're trying to slow the economy with the Fed, but we're stimulating the economy through our fiscal policy. So I think we have to all be cautious and say, what we're seeing right today, which, about 4.5 after this week's inflation print here in mid-April, we may be here for another year or so. And so I think we've got to underwrite, this kind of 5% short rates, 4%, 4.5% longer rates for at least another 6 to 9 months. And then probably in 25 after the election, we see rates start to come down some, but that's only going to be driven if the economy slows.
And then that inverted curve that we currently have, right?
Yeah.
Where short-term rates are higher than the long-term rates. You see, sounds like you're looking at 12 to 24 months. We remain stuck with an inverted curve.
Yeah, right now the market is pricing that we won't have a 4% SOFR rate. I think the market is not assuming that until October 25. So that's about 15 months away from now is what the market thinks how long it takes. Because we think about we're at call 535, 540 today on short rates. Even if we got 3 cuts, we'd be at 475 at the end of the year. And I think that's probably the best case right now after the inflation print. So I think what's important for, our industry always has a lot of hope. And we look backwards a lot. We're like, okay, well, we had low rates. They're coming back. I think we all got to be prepared and have our business plans set up where we can manage in a rate environment that is like the one we have right now and for a 1 to 2 year period at least, but not expect some magic cure that short rates are coming back to 1 or 2 and long rates are coming back to 3.5. I think those days may be done for a very long time unless we have a major recession. And a major recession is much worse for our industry than high rates.
Interesting, Mike. With all of the floating rate debt that has been originated, and then the thought that the short rates, keep high. What are you seeing in terms of different product type and how lenders are looking at the same information you are and dealing with, are they dealing with office differently than they're dealing with retail or apartments or, what are you seeing in terms of how that's impacting commercial real estate debt?
And I think what we're seeing is a very big bifurcation between multi-tenant office that may not be in great locations and everything else. So I think in multifamily in particular, and multifamily got down to 3.5 cap rates, and it's back to 5. So, but if you got floating rate debt, you're now paying 7 on the if you didn't cap your float, if your floater rolls off and it was 150 over, your short rate's 7. So you got real stress there. But I think both the borrowers and the lenders believe that multifamily will recover because we're cutting off the supply so quickly with these high rates. So what we're seeing is lenders will not compromise a loan on a multifamily deal. They are willing, if the borrower can't pay interest, willing to foreclose and own it. Same thing, we don't see any distress in industrial. Open air retail doing just fine. It wasn't levered up. We still got some malls to deal with. So the places we see, I think, more stress is in some of the hotel markets that haven't been able to recover as well. Some of the city center markets in particular, and then office product. And I think the office issue is less about what the age of the office is, because like in Century City here in LA, you can have a 50-year-old office product. It's still renting at 50% more than it did pre-COVID. So it's about location. Do you have the amenities, the public safety, and the commutability right? And so it's less about the age, it's more about the location. So in the office space, I think what we're seeing is that has been given the amount of money that it takes to keep paying for TIs and lease commissions, that's where we're having a lot of discussions between lenders and borrowers, where a lot of borrowers, particularly if they're in a fund format where they don't have tax implications of losing an asset, they are much more willing this time to give the asset back and cooperate to the lenders, and very sensitive about investing new money if they think the value of the asset is below the debt balance. And so office, I think, is a very unique category. The lenders would prefer not to own it because they will, but they prefer not to. And we're seeing a lot of borrowers right now who prefer not to own it either. And so there's a lot more cooperation going on on the assets that are challenged to try to find a path to the other side, so to speak, to either recapitalize the asset, sell the asset, put it in new hands with new money who can carry it through, what might be another 3 or 5 years of challenging times.
we hear a lot about rescue capital and
Yep.
preferred equity. And are you seeing actually that money being used to come into any of these transactions? Say you got a multi-transaction where you may lose the asset, or you have an office transaction where, as you were alluding to, you actually, to save the asset, you need to put more capital in for TIs and LCs. Are you seeing that money actually being used, or is it just sitting on the sidelines at this point?
So I think there's quite a bit of capital that's out there available to do rescue financing, preferred, et cetera. It's been challenging to find deals where the math works. I think what we're seeing is in the multifamily, for instance, most of the underlying owners have been willing to come up with a new capital versus take pref at 10, 12, 13%. We have seen some smaller developers, $50, $60 million deals. Somebody needs $10 million to pay down the existing loan, get an extension, buy a cap. So we're seeing some get done there. We've seen a little bit in the hotel space. What we're seeing in the office space is it's very binary, because most of the time, if an office situation has a problem, it's already, the value of the asset is already below the total debt balance. And so in order for that new money to come in, you have to create a negotiation between the lenders, and sometimes you'll have multiple lenders, either pari passu, or you have a mezz and a B note, or a whole, you get that negotiation to figure out what portion of the debt is going to subordinate to that new money. And in the office space, if it's a challenging asset, the cost of the pref is at least 15%. And the people putting out that money are looking to get at least 2 times their capital back. So that negotiation has been much longer and harder. And so we've seen more people moving to just doing some form of a short sale, where the lender says, okay, let's get it into new hands. Let's potentially do a joint venture with that new party, own a piece of the equity, do some sort of structured transaction, or just move on to a new party, maybe give them some financing. So a lot of rescue capital out there, but it's been difficult to get it actually deployed, given the differences in value today versus what the debt is.
Do you see any trouble on the horizon? And then you referred to hotel and office, and there are the sectors where maybe there might be some trouble brewing?
I think multifamily would be the next sector that's a sizable sector that had very aggressive pricing, and then we've had some supply issues. But what's happening, I think the new construction, and I think this is the perversion of high rates. You need more supply of things to get prices to moderate. High interest rates limit the ability of people to borrow money to create new supply, and that's what's going on in the housing space. I think that there's issues there, but I think they'll be resolved over the next 2 years. And we still got some of the enclosed mall stuff, but that's been such a focus of people for the last 10 years that most of that, a lot of that's been resolved, so it's not that big. So I really see this primarily focused in the office space, where you truly have distress, and it's focused not by building age, but by building location.
We've got a lot of partners who are in sub-debt positions. So they're in B notes, or they're in pref, or they're in mezz.
Yep.
What are you seeing the U.S. companies doing who are in the same boat? Are they being aggressive on foreclosure? Are they working out deals? How are they handling that situation, and particularly in office?
So I think what people are first doing that have that position is trying to make sure they really understand where the value is today, and how much capital is it going to require to get the asset, particularly the occupancies, come down to stabilize long term. So I think the first question each of those lenders are doing is, where am I at in the value? Is there still value above my debt? And then 2, how much money is needed to get the asset stabilize to a better market. And so that's the first thing people are looking at. And sometimes people are quickly realizing, the value is through my debt, and my best option is to sell it for it's value to other people in the market, because it's easier to foreclose on. My best outcome is to sell my position to somebody else, because I don't want to write the check to pay down the senior lender, or I don't want to write the check to stabilize the asset. So that's the first thing we're going through. Second, depending on how deep people's balance sheets are, some people are saying, okay, well, if the borrower won't pay and they won't put up new money, I have the capability and desire. I think this asset long-term works. So I'm going to execute a UCC foreclosure. I'm going to try to assume the existing debt that's ahead of me and work out a deal to get more time. And I think time is really what people are focused on right now. Is we were doing a lot of 1 year, extensions a year or two ago. And I think a lot of people are looking at it and saying, it takes 6 months to negotiate a 1 year extension, and then you're back at the table, 6 months later working on the next one. I think a lot of more lenders and borrowers are trying to figure out, is there a 3-year solution that allows the asset to get into better hands? So I think people are first looking at, what's my value? 2, how much capital is it going to take? 3, do I have the ability to keep the senior debt in place? And then after those 3 things, deciding, do I foreclose? Do I sell my mezz at a low price and move on? Or do I, try to see if I can stay in and get the borrower to do something?
Mike, you alluded to those longer term 3-year agreements. Are you seeing some of those agreements have so-called deeds in the box or pre-negotiated deeds in lieu of foreclosure, right? So if you can't get financing by that time, somebody in the lender capital stack will take over.
Yeah, what we're seeing is we're seeing a range of options. If the borrower will put real new money in, they usually don't have to put the deed in the box. Sure. If they aren't willing to put material new money, but the lenders want to give more time to see if the borrower can help improve the asset and fix it, then we are seeing people agree to a pre-agreed foreclosure process, particularly in certain states where mortgage foreclosure is very long. And that's where I think that's where people own mezz, which is a lot shorter foreclosure process. There's real value to that mezz, and so you want to make sure you get recognized for that. But yeah, I would say if new money comes in from the borrower, we're not seeing the deed go in the box. If no new money comes in from the borrower, we are seeing the kind of deed in the box, so to speak, where the lender, if the borrower doesn't perform, can more quickly foreclose or control the asset.
In terms of receivers, are you seeing the use of receivers a lot? And again, for some of the folks that might be listening to this from abroad, what is a receiver, and why would somebody want to put a receiver onto a transaction?
So a receiver is basically a third party that is working on behalf de facto of the lenders to come in and run the property, control the cash at the property, while the lenders and the borrowers are in the foreclosure process or potentially in the workout process. So it's a third party that is put in place through a court process to maintain the rights of the lender and keep the cash under control. We aren't seeing in the business we are involved with, which primarily the borrowers are, the larger deals, and the borrowers are institutional quality borrowers. We're not seeing that many receivers yet compared to the past, because most of these bigger borrowers are doing, are not, the lender is trusting them to try to do their best to help them get the asset positioned or help them do a sale or a consensual transfer from the borrower to the lender. So compared to other cycles, I think the loan docs are much better about quote unquote bad boy carve-outs, and so there's less need for receivers. There's been far less bankruptcy filings because of the springing recourse for bankruptcy. So we're seeing a little bit of receivers, but not nearly as much as the past.
Hey, Mike, you alluded to potentially selling positions, and I know obviously, you do a lot of that. And how are you seeing that market right now? And, are you seeing big discounts in terms of, and I'm talking mostly about sub debt,
Yeah.
talking about, pref or mezz, and how are people going about looking at that and pricing it?
So what we're seeing is people are, every deal starts with underwriting. What do you think the value of the property is today? How much capital does it take to get it to stabilization? And what's the value when you get done there? And what is those values relative to the mezz's position in this capital stack? Is the mezz impaired or not? So what we see starting out is there's kind of a minimum value for mezz, even if the property value is well below the mezz's balance. People will typically pay 10 cents on the dollar to buy that mezz for the foreclosure rights that come with it, which are a lot better, particularly in certain states, than mortgage foreclosures. You start with that kind of that's the minimum value of most mezz positions right now. And in two, people are looking at and saying, what are the rights of the mezz if they buy it? If they look at it and the senior debt still has more time, there isn't a test, so they could buy the mezz and control the property and keep the senior debt in place for a period of time to get the property stabilized, then that's another leg up in value for the mezz. But if there's a situation where somebody's going to have to step in and immediately pay down a big part of the debt that's ahead of them in order to get more time, people are factoring in, okay, I want to earn 15% to 20% on that money. So that obviously impacts price. But I would say the market is pretty efficient. There's plenty of money that wants to buy mezz, wants to buy loans. We're not in a market that is like past times where there wasn't any liquidity. There's a lot of liquidity in the market. The CMBS market's working well, spreads are tightening. So, people are, if they choose to transact in the market, they're doing them in a market where there's a lot of money that wants to buy these positions. And so therefore you can create competition to get rational pricing. Sometimes that may look irrational because of how much the value has fallen, but from a true underwriting standpoint, it's pretty rational pricing right now.
Let's go back to kind of bigger picture. We've actually gotten some of these questions from some of our investors. So are there markets that you think that overall valuations have bottomed or are near a bottom? And are there other product types or different markets where you think that there's probably a little bit more pain to be felt before markets have valued?
Yeah, I think in general, we are seeing the bottom in a lot of transactions. What we are seeing, for instance, in the office market, which everyone's very focused on. A year ago, you couldn't, if you had an office building that had challenges, you couldn't get anybody to spend time on it. Nobody wanted to buy it. Now we're routinely seeing, if we're bringing out an asset, we're routinely seeing 100 people want to sign the NDA. 50 people wanting to tour it, 25 people bidding on it. And we're now just, the new phenomenon that we haven't seen in a while is the first round bid is going up. When people put their first round bid in, if they go to a second bidding round, they're actually raising their price. And so you're seeing the market form a bottom, in my view, around office and frankly, everything else. I think the challenge that people have to be watching carefully is, what in certain of these markets, if when the asset does trade at the new value, that new owner has a cost basis below other owners in the market. And what we're quickly finding is the guy with the new cost basis and new capital to give for lease commissions and TIs is getting a far disproportionate share of any tenants that roll, because tenants want to go to the buildings where they know the capital structure is stable. And so I think the downside risk for a lot of people is, I think values are bottoming, but we haven't seen the impact yet on leasing of these new buildings that are down 50% to 70% in value, being in new hands with new money, starting to take tenants from other buildings who've been reluctant to invest capital because their debt is too high to justify putting new money in. So that's what the potential next leg down is getting hit on more occupancy issues. But I do think we're hitting bottom on where the pricing is for these assets.
Mike, for foreign investors, how are you seeing them? Are you seeing them re-enter the market, and if so, in what sorts of capacities?
Yeah, so we are seeing, we are seeing a number. We're doing a situation right now, which is that is involving, for example, a new investor out of Korea buying an office building that we're selling. So we are starting to see capital selectively out of Europe. We're seeing, we've just did a transaction in New York. We had multiple capital sources out of Europe that wanted to buy a New York office building. We're seeing, it's primarily been Singapore, selected Korea, and selected Europe so far. Haven't seen a lot of Middle East capital yet, or Canadian capital. So we are seeing offshore investors, and most of these are not offshore investors that have a lot of existing positions. It's kind of new investors who have new capital to invest, or wealthy families or private investors who have new capital to invest that are spending time on it, if you're talking about office. In the other asset classes like industrial and multifamily and data centers and other situations, we are seeing a growing amount of offshore capital. The hedging costs are still a little rough, but people are looking at and saying, the U.S. economy seems to be the best economy in the world. Owning dollars, the dollar just continues to strengthen, doesn't make it easier to come into. But if you want to have allocation of dollars, more and more people want allocation of dollars. So outside of office, we are seeing a growing interest from investors around the world in U.S. assets.
I've heard some talk about ULI was happening here in New York over the last few days, and a good vintage is what I'm hearing people say, right? In terms of this particular investment opportunity. How do you see this investment opportunity, and how does it stack up against post GFC? And also you referred to the RTC, which is a Resolution Trust Corporation for our listeners. How do you see this investment moment right now? And do you think 5 years down the line, people will say, boy, I should have invested more in 2024, or maybe I should have waited a year?
I think it's because we're 2 years into this correction cycle, and that usually by the time you're 2 years in, that's when you usually are seeing the bottom. What's different about this cycle is the economy has stayed so much stronger than normal when we go through these recession or corrections. And so, but then you look at Green Street data, their view would be office values are down 40 or 50%. That multifamily debt values are down 20 to 30%, that industrial values are down 15 to 20 from peak. I think people are looking at it and saying, okay, there's liquidity in the market, the CMBS market is working, the debt markets are functioning. I'm not investing in an illiquid market, and it feels like we aren't going to have that massive, black swan event like we did in the GFC. So I think people are going to be pretty pleased with the loans they originate in 24 and 25 and the assets they buy in 24, 25, because you really are at hitting a low, in my view, the most the correction we're going to have. I don't think we're having a materially more correction when we see the S&P 500 up 30% since a year ago, so every other asset class is doing pretty darn well. We get in the real estate space because of some of the challenges. We get pretty, depressed sometimes. But if we step back and look at what else is going on, bonds are performing extremely well. General equities are performing extremely well. So that's usually a good time to start putting capital to work, both in debt and equity.
Obviously, we've got the elections coming up. So how do you think that impacts things over the next few months as we lead up to the elections? And, what's your general thought?
I started the year being pretty concerned about trying to make sure we got deals done before say September, October, before we get too close to November. And I do continue to have that concern of that if things need to get done, in this year, I think we should be getting them done sooner than later, because, what I think the best case scenario, I think, is that by the time we get to November, the U.S. will be very tired of listening to both sides and just be happy to have the election done, and we keep on and everything goes through. So it'll all be baked into the system, so to speak, the expectations. The worry I have is if it's a very close election and it becomes some form of a disputed election, then you have people, possibly being a challenging environment to transact in November, December, and January. And so I'm a big believer the U.S. system finds its way. The checks and balances keep us in the right direction, even though we get a lot of noise and a lot of back and forth. But I do think that 3-month period, if the election is not a clear winner, where it's not an undisputed outcome that everybody accepts, we're going to have turmoil for 3 months that would be made to be difficult to get transactions done during that time.
Yeah, this is fantastic.
Really
Mike,
appreciate the time. Thank you for inviting me.
And thank you so much, Mike. Very
Thanks.
very insightful, and we really appreciate it. So thank you.